This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts here at the Citi Australia and New Zealand Investment Conference in Sydney. Your top stories this hour. Asian stocks are set for gains after fresh Wall Street records, with earnings optimism driving sentiment, but China's latest data disappointing, with credit and exports data expanding less than expected. Tokyo Metro's IPO raising $2.3 billion, with pricing at the top end of the range. It's a sign of hot demand for Japan's biggest listing in 6 years. And we'll be speaking live with the Citi Australia and New Zealand CEO Mark Woodruff about the bank's turnaround plan and his outlook for the economy.
And Haidi, global investors have been waiting for any signs of new initiatives coming from Beijing, especially after the disappointment from the finance ministry briefing on Saturday. Well, we're hearing now from Chinese local media that China could be raising 6 trillion yuan from ultra-long special government bonds over the next 3 years. That would be around $846 billion, according to Caixin, that says the funds will be partly used to help local governments relieve their debt burden. Of course, very important what happens in the Chinese economy for not only China-exposed assets, but also, of course, economies dependent on China trade like Australia, Haidi.
Yeah, and that is really sort of one of the front and centre topics that we'll be watching here at the Citi Australia and New Zealand conference for 2024. We sort of hear every year, and we are speaking to some really great lineup of guests today. And of course, China will really be top of mind for so many of the some 1,000 investors, fund managers, CFOs, and CEOs that are in attendance over the next couple of days. We will be speaking, as I mentioned, to the likes of Citi Australia's Mark Woodruff, really talking to him about, the China story and how that kind of potentially influences the growth trajectory for Australia and his outlook and what his clients are perhaps feeling at the moment, and the general sort of enthusiasm and confidence levels as the Australian economy continues to go through a pretty uncertain patch. We'll also be speaking to the global chief economist, Nathan Sheets, as well throughout the course of the week. Of course, so many things to talk about on a global level, including as we head into the November US election and how that China story sort of counterbalances developed nation growth stories as well, right? We also have Sarah Hunter, who's the Assistant Governor for the Economy at the RBA. So lots to talk about when it comes to, how the RBA still is on this hawkish pause, but when we might see the start of the right time for Australia to join the easing cycle.
Yeah, take a look at how the ASX 200 is coming online right now. That staggered open, seeing gains in materials and financial stocks at the moment. And of course, as we had already seen those gains in the previous session, Nikkei futures up 0.2%. They're coming back from a holiday. The Japanese yen has traded at around that 149 level, pushing towards 150 and weakening against the US dollar. Of course, we continue to see the strength of the US dollar, all to do with expectations of where the Fed goes from here. Take a listen to what the Minneapolis Fed president had to say about future rate cuts.
Today, monetary policy remains in an overall restricted stance, though just how restrictive is somewhat unclear to me. Ultimately, the path ahead for policy will be driven by the actual economic, inflation, and labor market data.
U.S. futures at the moment not doing much, but after we saw the S&P 500 already rise to another record high, the 46th this year, despite the fact that we had some losses in Chinese stocks listed in the U.S. The Golden Dragon Index seeing its worst day in a week. But Haidi, it was really all about those tech names. Nvidia leading the gains near record highs. Apple also gaining on a bullish analyst call. You have Crude, though, under pressure at the moment, down more than 2%. And this, of course, after China's highly anticipated finance ministry briefing. But we'll see if we see some support, especially after China's media reports about those ultra-long special government bonds, Haidi.
Let's bring in Shery Reynolds, who leads our Markets Live Asia coverage. He joins us out of Sydney. And Guff, despite the uncertainty over the China stimulus story, despite all of the geopolitical tensions that continue to erupt, we still see this outperformance, and this was a revival of tech again.
Amid all the uncertainty, investors are returning, to the familiar, to the equities that have delivered gains before, and there's plenty of justification for that when you consider that those are the companies that have tended to lead share gains that are also so key to the US economy and especially its capacity to stay resilient is the innovation and the get up and go that is exemplified by a lot of those companies in the tech sector. Now, the story this year so far has been precisely that even with the bond market, for example, at times pricing in what looked like certainty for a recession because of the Fed's very high interest rates relative to what had gone for most of the last 20 years, the economy has held up just fine. The economy is doing fine. Why wouldn't you look to rotate into shares rather than into bonds? And again, if you're looking for outperformance, the usual suspects come to mind, and there's nothing that sort of screams out that tech is about to tumble from here.
I know it's too early in the earnings season to be talking about this, but we seem to be already seeing some signs that some of the companies that have already reported earnings are actually benefiting from the Fed's easing cycle. What are we expecting for this earnings season?
Well, it's a little bit strange how to describe the expectations for this earnings season in that there are the expectations that have been generated by analysts about what profit growth will be, sort of mid-single digit in percentage terms. But then you have companies themselves effectively, signaling more like 10-15%. Investors are certainly very strongly positioned for a series of earning beats, and provided they get those, shares are likely to go higher. I suppose the one risk is if the analysts end up being closer to the mark than investors and companies are. But the very strong anticipation is there that despite the fact this was supposed to be one of a sort of serious step down in profit growth, instead we're going to get something that's much more sort of business as usual. And there is a sense that to some extent this is being aided by the fact that the Fed has started cutting rates, and that even at the beginning of last quarter it rapidly became clear the Fed was finally going to cut rates, and that has an immediate impact when you know that rate cuts are coming. And even if in a lot of ways you've got a Goldilocks scenario for equities, because the Fed's cutting rates, it even cut them boldly in the end in September, but it's also getting a good enough economic picture to signal it's going to be gradual about these rate cuts, and that means a soft landing for the economy is still very much in play. The Fed doesn't feel, and by now doesn't look like it's been too slow to move to easing. It's also not being led towards panicked easing because the economy is about to collapse. So in that scenario, equities look primed to go higher. The one thing that investors probably want to do is be very clear about when they would look to exit if things do turn sour, because over the decades, the Fed has very, very rarely succeeded in a soft landing. It's more often proved the case that once you get to look back with your proper hindsight on what they did, that they ended up keeping rates too high for too long and helping to tip the economy into a recession.
Garfield Reynolds, who leads the Markets Live coverage, of course, with a preview of the markets and where the U.S. economy could go from here. As we continue to watch where China is, because it could be raising $846 billion from ultra-long special government bonds over 3 years. That's as part of its efforts to boost the sputtering economy, and according to reports by Chinese media outlet Caixin. Let's bring in our China correspondent, Min Lo, in Hong Kong. And Min, we've been waiting for some sort of new measures to come out of Beijing. What could this potentially mean?
Yeah, this is likely to be the top story in China today. Speculations have been arrived about exactly how big that fiscal stimulus would be after the Ministry of Finance held that briefing on Saturday without giving us the headline number. And now Chinese financial media Caixin is reporting that the government could issue ultra-long treasury bonds, 6 trillion yuan over 3 years. Now, markets had been expecting 2 trillion yuan in additional stimulus. So this is likely to be in line with market expectations, according to Caixin, which reported this based on sources that gave them the information. They're saying that part of this funding is going to help tackle local government debt. And we know the Ministry of Finance had said that they are going to provide a one-off increase in local debt quota to swap out tens of trillions of yuans of local government hidden debt so as to free up more resources for these local governments to actually expand resources to spend on the economy to revive growth. We know the Ministry of Finance had also said they were going to issue more treasury bonds as well, special treasury bonds to recapitalize the banks. And traders are betting that we could perhaps hear the official announcement of that size by late October when the legislature meets. The NPC, the National People's Congress Standing Committee, is going to meet then. So we'll be watching this very closely, and also will be interesting to see how markets react when markets open later this morning.
We've been also watching for the market reaction to the downturn that we're starting to see when it comes to exports. This was a bright spot. Is it starting to fade?
Yeah, so trade data unexpectedly slowed down more than expected when it comes to export. It came in at about 2.4% growth in September. The expectation was 6%, so a very sharp slowdown there. Shipments to major markets like South Korea, Japan, Taiwan all fell, and shipments to US and the EU also grew at the slowest pace in 4 months. But Russian purchase of Chinese exports, though, that had grown to record high of $11 billion, and that's as Chinese companies move in to fill the gap that is left behind by these Western companies that pulled out of Russia because of those sanctions. Imports, though, inched up by just 0.3%, again reflecting that weakness in domestic demand. So we're still seeing this two-track recovery, and that wide trade surplus has been the source of trade tensions between China and other countries, prompting more countries to place trade curbs on China. So this strong momentum that we have seen in exports, that's likely going to be hard to sustain moving forward.
Bloomberg's China correspondent Min Min Lo there with the latest. And coming up next on the Asia Trade, we'll be hearing exclusively from the CEO of Citi Australia and New Zealand, as well as Citi's global equity strategist, as the 16th Citi Australia and New Zealand Investment Conference begins. Invesco also coming along to tell us why they think the US economy remains in good shape. Plus, in Australia Ahead, we take a look at government efforts to reform merger rules. This is Bloomberg. Well, the annual Citi Australia and New Zealand Investment Conference is getting underway here in Sydney, bringing together investors, fund managers, CEOs, CFOs from around the region and around the globe, some 1,000 of them, in fact. And joining us exclusively to kick off the conversations today is Mark Woodruff, who's the bank's Australia and New Zealand CEO. Mark, great to have you with us and great to be here again for another year.
It's good to have you.
What's top of mind when it comes to clients, when it comes to investors? What do you think will be the sort of overarching theme for the next 2 days?
Yeah, sure. I've just hosted the opening session with Nathan Sheets, our global chief economist, and that's followed by Candy Wolf. And I think that probably summarises, the key things for investors here at this conference is, the world economy, geopolitics, and then more locally, we've had substantial interest in things like the real estate sector. But as we lead into this US election, I think investors have a lot of questions in mind.
Probably a lot of questions about China too, particularly with the Australia proxy angle of how, fortuitously or not, that exposure is.
Yeah, that's right. And I think the investor base has been somewhat frustrated by the lack of clarity in terms of the stimulus package coming out of China, and that remains a key question for investors. Our chief economist from China is also here, providing insights. It'll be interesting to see over the clarity over probably the next month, I would think, in terms of what that fiscal package might look like.
It's interesting because, of course, we're talking at a time we will see yet another record high for US stocks, and it feels like this sort of desire to rally higher comes even with all of the tensions and risks that you talk about going into November US election, what's going on in the Middle East, the uncertainty over China. Do you think Australia and the clients that you have here feel sort of somewhat buffered by our position and the nature of this market?
I'm not sure whether we feel somewhat buffered. I think when you see risk enter global markets, I think Australia reacts to that risk. I think your original point is an interesting one. We have had a substantial increase in geopolitical tensions. We've had, really, if you look back over the last couple of years, substantial tightening in monetary policy, and only recently has that reversed. And yet, as you say, equity markets are at all-time highs. Sectors such as technology and financials have been key drivers in the US. And even last night we saw even substantial move in stocks like Nvidia. And I think that sort of speaks to a couple of things. One is the innovation piece, but also I think consumers have been more resilient than what people probably anticipated. And this is one of the things that Nathan spoke about, is that we do see consumers changing their behaviour around the value chain of what they might consume, but the aggregate still remains stronger than what we probably anticipated.
Sort of adjacent to that, I do wonder about your strategy when it comes to the wealth side of the business. Is that something that you're sort of actively pursuing, or where do you see the growth drivers as part of the bigger turnaround plan for
if we look at it from a global perspective, Andy Sieg joined Citi 12 months ago following Jane's announcement. He's got significant plans for wealth, and you can see the deployment of private capital is significant in the last 12 months, and that feeds through just from startups all the way through to really the largest deal that has been done this year, which was the Blackstone air trunk deal, which we advised on. So the power of private capital, I think, is probably as strong as ever.
Of course, Australian, your business is so well positioned in the energy sector. I wonder how much of that is really coming through in your business, global capital, when it comes to really attracting global capital in the energy sector, and even maybe other sectors like housing, where we know that Australia has a shortage problem.
Yeah, the energy sector is interesting. It's almost a little bit like the energy transition has taken a back seat in the media, but it certainly hasn't taken a back seat in terms of our investors. But I think what that speaks to is that it's a very long-term game. And we're probably seeing the debate around the energy transition balance out a little bit. I think initially it was something that was seen as something that was going to be of speed. And happen quite quickly. And I think the reality is that this is a very long-term game, but we're still seeing offshore interest in that energy transition story, mainly because it's one of the things in Australia that has genuine scale in terms of returns. So, we would expect that to continue. In terms of housing, real estate's an interesting sector. As I said earlier, we've had substantial interest in the real estate sector in this conference. In fact, 5 of our top 6 most in-demand companies here at the conference are from the real estate sector. And I think that speaks to the fact that what we've seen in the past, as soon as monetary policy starts to shift, as soon as we start to move towards that first easing bias, we do see a pickup in this sector, and we expect that to continue.
Does that mean that you expect your Australia business to grow in the global context for Citi? We heard that Citi has been hiring as well for the broader Asia markets business. I wonder if it's going to touch any of your divisions as well.
Oh, that's certainly my ambition and my ambition is significant. So we see Australia as a growth market, and through various sectors of our business. So all of our sectors this year have been on a growth path. So we've got a significant banking division, significant services division, which speaks to that technology innovation, through either the payments channels or through our custody business. And then we've got global markets. And I think, you see the strength of the equity markets. You see the intermittent volatility in markets, and that our clients are relying on us to deliver insights around that. So, I think Australia is very well positioned. If you look at it even in a regional context, we're a country that is growing GDP-wise. We've got a fiscal position that remains very strong, and geopolitically, we can benefit from tensions in other parts of the world.
I wanted to ask you about the outlook. What does the pipeline look like when it comes to banking volumes? There's obviously been a very nice recovery across Asia, but also for deals.
Yeah, that's right. I think M&A outlook remains quite strong. We're seeing, even in the last 6 weeks, an increase in that activity, and I think that's really driven by, firstly, more confidence that at least interest rates aren't going up.
Right.
So, we expect an easing by the RBA in February. That might be pushed out to May because of the resilience of the economy. But I think that confidence around the glide path of rates is really bringing bid and offer spreads together in terms of deal making. So I expect that. IPO markets are still challenged. I think we have to acknowledge that, but I think the overall banking activity remains very strong.
Mark, really great to have you with us. Mark Woodruff, Australia and New Zealand CEO at Citi, as we kick off the first day of the conference here. We do have much more coming up from the Citi Australia and New Zealand Investment Conference throughout the course of today and also on Wednesday. We'll be speaking with the global equity strategist, Beata Manthey, who says that the balance of risk has now moved in favour of cyclicals. That conversation is coming up in the next hour, Shery.
And Haidi will be watching energy stocks as we look at the Australian trading session today, because we have oil continuing to decline at the moment. Of course, we had some disappointment over China and more stimulus measures to come, but we also had news from media reports that sources are now saying that Prime Minister Benjamin Netanyahu has told the Biden administration he's willing to strike military rather than oil or nuclear facilities in Iran. We have more ahead on the Asia trade. This is Bloomberg. Bitcoin continues to move up 0.4%. It's now at the highest level in more than 2 months. Vice President Kamala Harris is now pledging to support a regulatory framework for cryptocurrencies. And of course, we also have a little bit of that Trump trade being back, those trades that pile into stocks or assets like cryptocurrencies that could benefit from Republican policies. And now that we're seeing that swinging back momentum into Donald Trump's favor in the upcoming elections, that's according to election prediction markets. At the moment, you have Solana gaining 0.9%. Former President Trump will sit down with Bloomberg editor-in-chief John Micklethwait for an exclusive interview exactly 3 weeks from Election Day. Catch that conversation. This is Bloomberg. Take a look at how we're trading across Asia early in the session. The ASX 200 up 0.6%. Materials, real estate leading those gains. Nikkei futures pointing to the upside of more than 1%. Of course, Japan is coming back from holidays as the yen continues to weaken towards that 150 per dollar level. U.S. futures not doing much, but this, of course, after already notching another record. It's 46th already this year. Let's bring in Kristina Hooper, Chief Global Market Strategist at Invesco. Kristina, always great to have you with us. We continue to see the tech mega caps rallying. How much more room is there for further upside?
Well, keep in mind that we did go through a period of, relative stagnation, right, where we didn't see much in the way of price moves for some of the mega cap tech names. So they're back on fire. And that really makes sense given the environment in. There's more uncertainty. We've got, of course, a flare up in Middle East tensions. We also, of course, have a presidential election right around the corner. So there is a move towards quality, towards secular growth in the face of uncertainty. Also, of course, we have significant earnings growth there. So a lot of different drivers, I think, of the popularity.
But we have so many more earnings results to see from here on out, right? Is it a bit too early to be optimistic and encouraged by what we've seen already about some of these companies that have reported so far benefiting from those rate cuts already?
I don't think it's too early to be optimistic. It might not necessarily be largely driven by rate cuts, but we do have some compelling drivers right now. Certainly, this is an environment in which tech is performing well because earnings growth looks very good. And that's not going to change anytime soon. Also, if we look overall at the stock market, what we're seeing is diminished expectations. We've had expectations for earnings growth managed down. And so it's going to be, in my opinion, pretty easy for most companies to beat those diminished expectations. And that's actually a pattern we've seen in the last several years, where we've had expectations that are well below where companies have come in general.
You would think that expectations when it comes to China have well and truly down there, right? But it feels like markets are being consistently disappointed now by what policymakers are announcing. Which camp are you in? Is this the real deal for a China revival, or do you think this is another false dawn?
I'm in the camp that believes this is the real deal. Because I think it's very important that we get the two components of stimulus together, the monetary stimulus and the fiscal stimulus, and we're getting both. Yes, there might not be as many details as everyone wants to see, but what we know is that the fiscal stimulus is going to address key areas that I think will lead to improvements that benefit the economy and markets over the medium and longer term. So in my opinion, this is very comprehensive and thoughtful, everything we've heard thus far, and I'm very encouraged.
Yeah, it's interesting. I feel like you're maybe one of the few people that have at least sort of expressed that they weren't disappointed by the finance ministry briefing over the weekend. The fiscal needs to come through, right, for this to work?
The fiscal does need to come through for it to be as powerful as it can be. You can certainly make some improvements with just monetary stimulus, but I do think it's a powerful combination to have the fiscal as well. And keep in mind that what we're seeing is policymakers not focused on an immediate win, but addressing areas for structural change that I think will be very impactful over the longer term. So this is prudent. This, to me, is actually, now I wouldn't want to say a Goldilocks outcome, but it's certainly a very attractive outcome to see addressing areas like the property sector, addressing areas that shoring up local finances. All those things I think are very important and should benefit the economy and markets. Maybe not tomorrow, but I think they'll be very impactful.
Kristina, when there are so many variables around the world, of course, not only China, but the Federal Reserve, wars around the world as well, how do you hedge? Do you go into safe haven assets like the classics, treasuries, maybe gold, or even the Japanese yen? But the yen is now weakening.
So I think it's really important to be well diversified and think about components of your portfolio as appropriate for geopolitical risk hedges. And what we're seeing too as one of the areas of the go-to areas for, what is perceived to be safe haven asset classes is gold. Now, interestingly, that wasn't really the case more than 10 years ago. Treasuries were considered more of the go-to safe haven asset class. But that has changed. We've seen diversification in safe haven asset classes or perceived safe haven asset classes, so that now there are more investors moving to gold. I think having several different asset classes that can help hedge risks, to also consider alternatives such as private credit, also looking to areas like real estate that have lower correlations. Those can be hedges as well when you encounter turbulent markets.
Kristina, really great to have you with us. Kristina Hooper, who's a Chief Global Market Strategist at Invesco. And as Shery was mentioning, myriad risks, including, of course, we're watching the latest developments when it comes to the Middle East. We are seeing Crude now extending those losses. We did have a report that Israel may avoid targeting Iran's crude infrastructure. That's really eased a lot of those ongoing concerns across the region when it comes to risks for oil supply. OPEC also lowered its demand forecast for this year and next. And I'm here at the Citi Australia and New Zealand conference, and Citi in fact raised its bull case for Brent to $120 from $80 this and next quarter, and that is on the potential supply disruptions in the Middle East. So we'll be watching for some of those sort of convergent views there. But let's bring in Michael Heath, who joins us now from Sydney to get the latest. Mike, we've been talking about this almost every day. There's been a bracing for really the last 2 weeks as to what this reprisal might look like, and not to mention the fact that we actually have had the first conversation between Biden and Netanyahu in almost 2 months.
Yeah, that's right, Haidi. And I think that Washington Post report sort of confirms a lot of suspicions in that there was the conversation between Prime Minister Netanyahu and President Biden, and the US announcing also that it was going to send its THAAD, the missile defense, US missile defense system, which will sort of bolster Israel's defences against any Iranian reprisal for what Israel does. And the sense there is that Netanyahu's probably given Biden some assurances on what the sort of targets that Israel will strike there, that they will be military targets or military infrastructure, that it's not going to be going after the nuclear side, which would potentially provoke an all-out regional war, or the energy infrastructure, which could lead to upheaval in global oil prices, particularly in the context of a US election. And that was part of the report too, that Netanyahu's cognizant that he doesn't want Israel and how it responds here becoming a factor in the presidential election, even though it's sort of very difficult to see how it is, and given the sort of polarising nature of that conflict and how people respond to it in the US.
And at the same time, we have Hezbollah stepping up drone attacks on Israel.
Yeah, Shery. I mean, on Sunday they managed to get this drone that came in over the water, and they flew it very low, it seems. That hit a base. 4 Israeli soldiers were killed, and about 50 were injured, is the latest reports. And Israel's obviously investigating that. We've had there were 90 projectiles fired yesterday. So despite Israel, basically eliminating much of the senior command, or the whole senior command of Hezbollah and all of its attacks on the rockets, it really does underscore how well armed and how well supplied Hezbollah is, that it can take that punishment and it can still be firing 90 rockets. It can still be doing damage to Israel. And again, yesterday, people in the central Israel area were forced to run to bases because of sirens and alerts there. So Hezbollah is still up and going. As I've mentioned before, with Gaza, it's sort of separated from its supply routes. Hezbollah in Lebanon can be supplied, via Syria, so it can be rearmed, it can be restocked. And obviously they're trying to recruit or reappoint people to their senior positions. But it does remain an ongoing concern, and of course a concern for Israel as well.
Bloomberg's Michael Heath there with the latest on the Middle East crisis. We have more ahead on the Asia trade. This is Bloomberg.
The UK Prime Minister Keir Starmer has rejected a suggestion that his government is considering raising capital gains tax to as high as 39%. Starmer told Bloomberg that he's leading a pro-business government. He spoke to us exclusively at the UK International Investment Summit in London.
Well, quite a lot of speculation is getting pretty wide of the mark, but
so you say that 39 is wide of the mark?
It's getting to the area which is wide of the mark. But I'm not going to fuel the speculation, because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget. So that's why we put the timing as it is. It's the right timing. But equally, it's been really fantastic to have this investment summit just a few weeks before the budget, where the mood music here is very upbeat. People are talking about a real opportunity now to invest in the UK, comparing it as a sort of relative advantage across the world. We want to seize that opportunity and take it forward with many of the investors that are here.
You said it's the right timing for this summit. It does feel a bit odd that for those people in the room, people who are doing deals today, you can't promise them that the basic tax environment for entrepreneurship, for business, for wealth, in a couple of weeks' time won't be completely different.
Well, they're very interested that corporation tax is capped. They know exactly where that is in the long term. They're very interested in the fact that we're able to say that because we've got a good, strong majority in government, we're able to make decisions based on years, not months, with a clear strategy. They're very, very interested when I talk to them about being a mission-driven government, a government with a real sense of purpose measured over years, with one central purpose, which is wealth creation translated into jobs in different parts of the United Kingdom. That's the sort of stability that they're looking for, and that's the conversations we're having. They're very pleased to hear that from a government, are very pleased about the clarity. There's no end of people here today who said the clarity of the message is really welcome. It's now the follow-through, which is actually the execution of it. What are you prepared to do when it comes to planning? What are you prepared to do when it comes to regulation? It's not just the number of regulations, it's the inconsistency of regulation that we need to deal with. And when I'm able to say with real confidence and certainty and clarity, yes, we're going to deal with that, that leads the decisions, in my view, to make the sort of investment that we've seen in recent weeks, which is very welcome. These are not just big numbers, although they are big numbers. They translate into jobs around the United Kingdom, good, well-paid, secure jobs. And that's the change we promised at the election, and the change that I'm determined to deliver on.
So you talked about mission-led government, and ethics-led government's obviously been a feature. You had a sort of unfortunate slip on the way to this summit involving DP World, which I'm not going to go into, you'll be glad to know. But there is another company, Shein, which was considered to be such a rogue operator in the US that it hasn't been able to list on the US stock market. It was too controversial, its working practices. But it seems that that your government is continuing their sort of open arms policy for wanting Shein to list here. Is that right? Well,
I think we've got to get the balance right, and clearly we've got to have standards, high standards. We do have high standards, not least, for example, in rights at work, and I addressed that in my speech here today to say, look, better rights and protection for people in their workplace are good for growth. So we're clear where we stand on standards, but we're future looking, we're pragmatic, and subject to those standards, then yes, we do want investment into the United Kingdom because we desperately need growth in this economy. We haven't had meaningful growth in the economy in the United Kingdom for 14 long years. We're determined to turn that around.
But just to be clear on that, so the government would need to be sure that Shein's not using forced labour in Xinjiang before it could list in the UK?
Well, I'm not going to get into individual businesses. What I will say, and be very clear about it, standards and high standards do matter to us. So of course we'll be looking at any issue that goes to high standards, with a particular feature on the rights of the workforce. We've been really clear that we see that as two sides of the same coin when it comes to growth. Good employment rights and protections, and a lot of drag on growth. They're fundamental for growth, and I think pretty well all good businesses understand that.
UK Prime Minister Keir Starmer speaking exclusively with Bloomberg's Stephanie Flanders.
The latest from the corporate front that we're tracking, European automakers at the Paris Auto Show say demand for EVs is recovering as prices for plug-in models come down. The Renault CEO, Luca says EVs made up about 40% of sales at a recent event in Paris. And Stellantis CEO, Carlos Tavares, told us the partnership with Chinese automaker Leapmotor is bringing prices of its EVs down.
We are using to bring compact cars to the market, like the new Citroën C3, that we bring to the market at 23,000 euros, which is the core of the market in terms of pure EV. And that price is extremely competitive. It's on par with the Chinese capability. And that kind of offering is also profitable for Stellantis.
Tokyo Metro's IPO is said to have raised $2.3 billion after the company priced shares at the top of the marketed range. Sources say the subway operator priced shares at 1,200 yen a piece for Japan's biggest IPO since SoftBank's $21 billion listing in 2018. The deal has drawn significant attention from global investors, with long-only funds covering the entire international order book. Japan's financial regulator is planning to examine banks' lending to private equity and other funds in the US and elsewhere. The Financial Services Agency says it needs to check if there is effective governance and risk management as the country's biggest banks ramp up so-called subscription finance. BOJ figures show Japan's largest lenders have more than $25 billion in such loans to American firms. Adobe has unveiled a new AI video generator hoping to capitalize on demand for the emerging technology. Shares have fallen 15% this year as rivals, including OpenAI, have released video tools of their own. CEO Shantanu Narayan told us more about how Adobe plans to compete.
We have been hard at work ensuring that our Firefly set of models works on things like images and vector and design. But today is a big day because we have been releasing our Firefly video models. You know, our strategy has always been that it's not just about the models that people develop, but it's the integration with the apps where the real magic is. And so we've had 13 billion generations where people have used either Photoshop or Illustrator to do it. And today that magic comes to video in Premiere Pro, will be in After Effects, as well as on Firefly.com.
Shantanu, the most interesting part is the accessibility. There are no usage limits, one. But beyond the basic subscription fees, you're not charging for the AI tools. Will that change?
Well, our focus really first is on ensuring that we develop these great models. We're very differentiated, and these models were designed to be commercially safe. So they've only been trained on licensed and public domain content. And, you know, we want people to experiment with it. So I think clearly on the imaging, vector, and design front, we have said as part of the subscription, we don't want you to think about credits. We just want you to experience the magic that exists. Video might be a little bit different, Ed. What we've announced today is that it's available in a beta form. The cost of producing video is clearly a little bit more expensive. But first steps is to just get it in the hands of people, have them try it, give us feedback, make sure it's specific. And then as I think the amount of video that's being generated is expanding, we will probably have different pricing models for that.
One of the features is to take an existing piece of video and use generative AI to extend beyond actual. As someone that trained in their early career on Premiere, I'm excited to use that. How technically difficult was it for Adobe to achieve that versus the work you've done in photo?
Well, every time you show something in photo and people say, oh my God, that's magic. To your point, the ability to extend that into video across every frame is so much more computationally intensive as well as challenging in order to do. But the use cases are so dramatic. You've had a video, for some reason, unfortunately, it got clipped off and you just want to extend it. You have video that you want to align with audio. The song is not long enough. How do you do it? So I think this generative extend concept, which is really something that's very pervasive in video editing, is something that the customers will really like. The other thing that we've done is because we can now analyze every frame, when you want to remove something that inadvertently came into the image, you don't have to go through the entire process again. You can just, through post-production, change it. So some pretty incredible stuff. And we're really excited to see what our customers do with this.
Adobe CEO Shantanu Narayan speaking with Bloomberg Technology co-anchor Ed Latlow. And these are some of the other stories that we have on the corporate front. IBM says it's looking into allegations against its China head after a letter circulating online accused the executive of misconduct. Chinese media outlets report that a former employee accuses IBM's Greater China chair Chen Shudong of receiving gifts from business partners and leaking company information. IBM has confirmed the existence of the letter and says it takes any allegations of wrongdoing seriously. Tesla is said to have used humans to remotely control some capabilities of its Optimus robot prototypes at the company's recent Cybercab event. Sources say employees stationed elsewhere oversaw many of the interactions between the humanoid machines and the attendees. CEO Elon Musk did not disclose that during his remarks on a webcast. We have the market opens in Seoul and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. After another record high on the S&P 500, we're talking about the 46th this year already, Haidi, and we could see a little bit more positive sentiment perhaps today with Chinese media now reporting that Beijing is seeking to raise more than $800 billion in special government bonds over the next 3 years.
So the incremental news feed from Beijing continues to be a major driver, though at the same time, of course, Shery, we're seeing that disappointment when it comes to, one of the bright spots for the Chinese economy, trade, exports looking like we're starting to see a little bit of flagging, momentum there, not to mention some of the weakness across credit numbers. And here at the Citi Australia-New Zealand conference, certainly this topic of China and, regional exposure through these economies is really top of mind.
Take a look at how Japan is coming online, because we'll be following, of course, the weakness of the Japanese yen as well. We are talking about levels that we haven't seen in a few weeks and headed towards that 150 level. If we touch that, that would be the first time since August 1st. But that weakness in the currency space is really leading to perhaps some of those exporter gaining ground. The Nikkei up about 1% at the moment, as well as the topics. And the Kospi also rose to the highest in more than 2 weeks. Let's see how it's really opening the trading session today, upside of about 0.4%, while the Korean won is holding steady. This after falling to a 2-month low against the U.S. dollar, and really to do with that strength in the U.S. dollar, but also because exports of tech products have slowed for a second straight month in Korea. So perhaps, Heidi, a little bit more of an indication of that sort of a weakening global trade picture that you alluded to with those Chinese export numbers.
Yeah, take a look, Shery, at how we're tracking when it comes to just an hour or so into the start of trading here in Sydney. It's quite interesting, even with the sort of wavering over what we could potentially expect from Beijing policymakers, the disappointment over the lack of details on the fiscal side and some of the waning trade numbers as well. We are still seeing some leadership when it comes to the miners and the sort of core iron ore players here in Australia. We're seeing upside of about 0.7% when it comes to trading here. Some of those financials as well also showing leadership, really tracking the US session higher as well. Energy shares, though, tracking the weakness that we've seen in oil prices, of course. Some of that relief coming from the fact that we have had that report about a conversation being held between President Biden and Benjamin Netanyahu, and the sort of reluctance now to target oil infrastructure as part of this long-awaited reprisal that we've been sort of bracing for over the past couple of weeks. But let's get to some more calls on where we see markets headed from here. Strategists at Citi are seeing 5% gains in global stocks by mid-2025 on the hope of a soft landing. With us now is Beata Manthey, who's a global equity strategist at Citi. Beata, really great to have you with us. So you talk about investing around this balance of risks and what a balance it is at this point in the year.
So equities are always about the balance of risks, right? This balance has been deteriorating into the summer. Equities went into more defensive mode. It was only about defensive sectors. It was only about the US leadership. And we've been noticing since September, it's still net negative, but it has started to improve. So perhaps out of the Europe, the data is bottoming out. Of course, China's stimulus is definitely a positive surprise. And the Fed easing cycle that brought back the hopes of soft landing out of the US again through better than expected data adds to this balance. So we are improving.
It feels like, particularly when it comes to the US piece, that investors keep going back, right? We see the revival again of tech. There are good fundamental reasons why they keep doing that amidst all of the uncertainty.
Absolutely. And the market over the longer time is always about the fundamentals. And especially this year, since the summer, early summer, that earnings for most parts of the world and the cyclicality have started to be downgraded severely. In Europe, actually, the level of downgrades by the analysts have come to the levels rarely seen outside proper recessions, right? Well, of course, the AI trade and the Magnificent Seven kept delivering and over-delivering. So no wonder that the US have been doing better, and that's how we've been positioned as well. So US until now is our overweight, but we've started to add a bit of cyclicality, and our top pick for within the rest of the world outside the US trade for now is Europe.
Of course, money has to flow from somewhere, right? It was very interesting that you also underweighted Australia as well as Japan. Tell us a little bit behind that rationale.
Absolutely. So Japan downgrades, it's relatively recent, and it's really based on the premises of the strengths of the yen going forward. So we have yen going to 135 into the next year, and of course that could put pressure on earnings momentum. As I said, we watch what is happening to earnings around the world very carefully this year, and Japan has been the one region within the cyclical part that has been benefiting from upgrades driven by the weakness in yen. We worry in the near term it could turn as from being a tailwind to being a headwind. And again, it's always about the relative trade. So Europe has been seeing these downgrades for quite some time, and on a relative basis, given it's more beaten down by the market, it has more upside squeeze if the right circumstances and indeed if this balance of risks continues to improve. Australia, on the other hand, also a cyclical market, very heavy in resources, very correlated to China. There are two most correlated trades around the world to China. One is Europe, one is Australia. But Europe is more broader spectrum of sectors that get exposure to that trade. Australia is really commodities, and we worry that we don't hear enough out of Beijing in terms of infrastructure spend. So perhaps there is not as much for commodities, for metals and mining, as we've been used to through previous stimulus.
Okay, but to be fair, as we speak, Japan's Nikkei is now above that 40,000 level for the first time since mid-July or so. Give me your yen call, sort of how that and where the Japanese currency strength goes from here really factors into perhaps some of the sectors that you don't like in Japan and perhaps some that still have some value and opportunity.
Sure. So we have, as I've mentioned, we have 135 on yen, so it's a bit up from the current levels. But what I would like to emphasize, really, if the landscape I've been describing at the beginning does play out, Japan is going to do well as well, right? We have positive upside for Japan. It's just on a relative basis. Other cyclical markets look a little bit better positioned right now to bring higher returns. Nonetheless, we have positive returns for Japan as well.
I noticed we've been talking around China, so I do wonder, are you compelled at all by the opportunity, either with direct or indirect exposure, or is it too early at this point to be able to say that this is kind of the real deal?
It's early to say, but of course it is quite encouraging that we keep getting more and more details out of Beijing, right? So in Europe, as I've mentioned, there is a broad range of sectors exposed to China. Same for Japan. We call them China proxies. So developed markets, for example, one of big parts of Europe. And all these sectors with big exposure to China over the summer have been really under pressure. Their EPS has been cut dramatically, much more, 3 times more than the overall market level. So we are getting at a very low entry point with a relatively decent derating and looking attractive if there is more to come out of Beijing. Of course, we would like to see some more news flow on the broader consumer stimulus. That would be definitely a net positive. For now, the market is in a waiting mode. Right? There is a fair level of skepticism.
So is there one catalyst that you would need to say, I've changed my call on A shares or H shares?
So for now, we are neutral in emerging markets in the global allocation. China is a neutral. And if the balance of risk continues to improve and we pass the US election and we know what the outcome is, you'll be able to allocate better to emerging markets. Of course, what is holding off investors and us as well in going more positive on emerging markets is, of course, risks of the Trump win, which could put pressure on China overall, right? So that's one caveat. There's these political risks hold us off from being more constructive.
Beata, really great to have you with us. Beata Manthey is a global equity strategist at Citi here at the Citi Australia and New Zealand conference. We'll be continuing our live coverage here tomorrow from the conference here in Sydney. We'll be speaking to the RBA Assistant Governor Sarah Hunter, also the United States Studies Centre Senior Fellow Bruce Shery.
And Heidi, we have breaking news out of China right now. Bloomberg has learned that China has begun enforcing a long overlooked tax on overseas investment gains by the country's ultra rich. Now, speaking to people familiar with the matter, some wealthy individuals in major Chinese cities were told in recent months to conduct self-assessments or summoned by tax authorities for meetings to evaluate potential payments, including those in arrears from past years. The move underscores, of course, when we've seen this growing urgency in Beijing to expand their sources of revenue. We continue to see land sales tumbling and, of course, growth slowing. And it sort of aligns with President Xi Jinping's Common Prosperity campaign. Again, Bloomberg has learned that China has begun enforcing a tax on overseas investment gains by the country's wealthiest. Heidi.
The focus remaining firmly on China. There's a lot going on, certainly for investors. But we'll also be taking a look at the competition landscape when it comes to Australia, how the lack of competition potentially is impacting consumers and the broader market. We'll be getting analysis from Barrenjoey's Tom Kierath a little bit later this hour in Australia ahead. But first, back to China. It could raise almost $850 billion from special bonds to boost the economic recovery. With the latest when it comes to these stimulus plans out of Beijing next. This is Bloomberg.
We continue to follow the latest developments in China. Beijing may reportedly raise $846 billion from ultra-long special government bonds over 3 years as part of its efforts to boost the sputtering economy. Let's bring in our China correspondent, Min Lo, in Hong Kong. And Min, after that disappointment from the finance minister briefing on Saturday, how big is this?
Yeah, well, markets had been expecting at least 2 trillion yuan in additional new stimulus, and the finance ministry briefing on Saturday failed to give us that headline number in terms of the scale of this stimulus. Traders are betting that we could maybe get the official numbers perhaps at the end of October after the legislature meets, because any increase in the budget deficit has to be approved by the legislature. But now Chinese financial media Caixin is reporting that the government could issue ultra-long special sovereign bonds worth 6 trillion yuan over 3 years. That is largely in line with expectations, or perhaps even better than expectations, that multi-year consistency in terms of this stimulus plan would likely bring confidence to investors. Now, according to Caixin, part of that funding is going to be used to tackle local government debt. And we know the Ministry of Finance had said that they are going to allow this one-off increase in local debt quota to swap out tens of trillions of yuan of hidden debt from local governments, and that would free up the pressure that local governments face in repaying their debt, and instead focus more on expanding resources to spend more on the economy, to revive growth, and to pay back all those delayed payments that local governments have been owing to contractors, direct and indirect employees. So hopefully that would be a sort of cash transfer, if you will, equivalent to a sort of consumption stimulus when local governments get all their payments out.
We're also seeing some taxation enforcement when it comes to ultra-high net worth individuals, and this, of course, coming at a time that we see really dwindling local government and broader government coffers.
That's right. This is a long overlooked tax, and it looks like China is now enforcing this tax on overseas investment gains for the ultra-rich, and some wealthy individuals in major Chinese cities are being asked to conduct self-assessment or being summoned by tax authorities to discuss or evaluate their tax payments, and also including those in arrears from past years. Now, these individuals could face levies of up to 20% on their overseas investment gains, plus penalties on overdue payments. And according to sources, the final amount appears to be negotiable. Now, this shows the urgency that the Chinese government faces in really increasing the sources of revenue that it has, given that fiscal revenue has really collapsed on the back of the weak land sales. Land sales revenue was down 25% in the first 8 months of this year. Fiscal revenue down 2.6% from last year, and tax revenue as well down 5.3% because of the weakness of the overall economy. And it also dovetails with President Xi's Common Prosperity campaign, right, to reduce that income gap between the rich and the poor, with this multi-year crackdown on various sectors, including the financial sector, the property sector, consumer internet sector, and now it looks like it's the ultra-rich individuals who are now the target of this campaign.
I mean, given all of the domestic challenges, we had seen Beijing at least be really comfortable with the external demand picture. It seems that exports, though, are now suffering as well.
Yeah, so exports had been that one rare bright spot for the Chinese economy throughout the year. But September data, though, that really disappointed, because exports came in at 2.4% growth. That is less than half of the median forecast of 6%. Exports to the major destinations like South Korea, Taiwan, Japan all fell. The ones to the US and EU grew at the slowest pace in 4 months, and imports as well just inching up by 0.3%, reflecting that persistently weak domestic demand and this two-track recovery that is still going on here. But that strong momentum that we had seen in exports data throughout the year, that is starting to peter out. Analysts are saying that there is going to be quite challenging to keep relying on exports to drive growth, especially given that that widening trade surplus has been a source of trade tensions between China and the rest of the world.
And we've been also following credit data, and that's also looking pretty weak.
Yeah, well, we had a pretty mixed picture when it comes to credit data. The headline number actually increased better than expected, but most of that is really driven by government debt, because we saw the second highest level of local government bond issuance, 1.5 trillion yuan, and that really drove up the headline number. I think that's the yellow line that is indicating government borrowing. But then if you look at new yuan loans, that is still declining or growing at a slower pace. And if you break that down to corporate, mid and long-term loans, that is about 300 billion or so less than the same period last year, and reflects that reluctance among companies to expand investment. The same thing for consumers' mid and long-term loans, which is pretty much a proxy for mortgages. That is less than half of what it was a year ago, reflecting that pessimism around the housing sector recovery. And we know the PBOC has unleashed this very powerful monetary stimulus in September. That's likely going to take some time to materialize, so it's not showing up in the data just yet. But hopefully with the stimulus that we're seeing, perhaps the 2025 credit growth data could be steered into healthier territory.
Bloomberg's China correspondent Min Min, though, there with the latest on the Chinese economy. We have more ahead on the Asia trade. This is Bloomberg. We're keeping an eye on oil prices and, of course, those energy stocks as well across the Asia session. We have been watching China's highly anticipated fiscal stimulus. The finance ministry briefing on Saturday sort of underwhelmed, but we're also getting some more reports that we could see more government bond issuance, not to mention that China is willing to really enforce taxing on their ultra-rich. In the meantime, we're seeing that downside continue because OPEC trimmed their demand forecast for this year and next, and at the same time, we continue to follow, of course, geopolitical tensions and media reporting now that Netanyahu has told the Biden administration he's willing to strike military rather than oil or nuclear facilities in Iran. Let's bring in Bloomberg's Michael Heath joining us now with the latest on the geopolitical tensions in the Middle East. Mike, what do we know?
Yeah, Shery, the Washington Post was reporting that that Israel has basically given the US assurances that it will look at that it will only target Iranian military installations and facilities. There'll be nothing in terms of the nuclear infrastructure or oil and energy infrastructure as well. So it's a little bit it sort of, I guess, ratchets down the tensions there that. While an attack from one state to another is always a very, very serious issue, that it perhaps won't be at quite such a high level. And we sort of got some buttressing of that because the US also announced that it would be deploying missile defence to sort of bolster Israel's ability to defend itself from Iran as well. So, it does seem to have just reduced some of the severity of the tensions, but nonetheless, a state-to-state attack is always going to be a serious issue, and the potential for something to go wrong still remains high there.
Bloomberg's Michael Heath there in Sydney. Well, Canada and India have expelled each other's most senior envoys as the diplomatic rift erupts again. Canada ordered 6 Indian officials to leave after Canadian police said they had clear and concrete evidence that Indian diplomats were persons of interest in the murder last year of a Sikh activist. India later announced it had expelled 6 Canadian diplomats, including the top envoy, in New Delhi.
I think it is obvious that the government of India made a fundamental error in thinking that they could engage in supporting criminal activity against Canadians here on Canadian soil, whether it be murders or extortion or other violent acts. It is absolutely unacceptable for any country, for any democracy that upholds the rule of law.
Former President Trump will sit down with Bloomberg editor-in-chief John Micklethwaite for an exclusive interview exactly 3 weeks from Election Day. You can catch that conversation at those times on your screens. Let's take a look at how European futures are opening at the moment, and this as we see Asian stocks really tracking those gains that we saw in the US overnight. We'll be watching when it comes to some of the pressures when it comes to German stocks, as well as this idea that, of course, we continue to see kind of the wavering for the outlook for European companies based on expectations on China's fiscal stimulus measures. We are seeing some upside there to track that broader global rally. Euro Stoxx 50 futures up by about just over over 0.25% to the tune of what we're seeing for German DAX futures trading at the moment as well. On that Monday session, we did see Euro stocks really gaining on the China story about giving more details on plans for fiscal stimulus, as well as really seeing some of those gains across travel and leisure stocks being quite muted as well. We had a report that the UK Chancellor was considering as much as $3.9 billion of new taxes across the sector.
And take a look at how Fujisoft is trading in the Japanese session. We're seeing it surge at the moment. We had reports last week that Bain Capital made a binding takeover proposal for Fujisoft. It's seeking to outmaneuver KKR, which has offered a lower price for this software developer. Fuji is now surging in the Asian session. It's come out this morning and said that there was no discussions yet on the offer conditions and that it will carefully consider the offer from Bain Capital. We know that Bain is proposing to pay 9,450 yen a share for the company, which compares to KKR's around 8,000 yen level. But take a look at also Korea Zinc, the world's top zinc refiner, rising right now in the Korean session. Buyout firm MBK Partners saying that it's acquired a large enough stake to help it win control of the company. This is another closely watched takeover battle. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're tracking when it comes to Asian markets as we continue to track those gains in the Wall Street session higher. Those declines across oil, though, really are impacting energy stocks as one of the laggards that we're seeing. But broadly, we are seeing the Nikkei 225 up by 1.25% following that strong performance again on Wall Street with those stocks hitting fresh record highs. We're seeing some of those gains a little bit more muted when it comes to the Kospi, but miners and financials leading the rally when it comes to trading in Sydney. We're also seeing a slight advance when it comes to US futures there as well. Earnings, of course, really poised to drive the sentiment story in the US this week, with the S&P 500 in the previous session up by just about 1%, the 46th record high that we've seen this year.
Haidi, European automakers at the Paris Auto Show say demand for EVs is recovering as prices for plug-in models come down. Renault CEO Luca says EVs made up about 40% of sales at a recent event in Paris. And Stellantis CEO Carlos Tavares told us the partnership with Chinese automaker Leapmotor is bringing prices of its EVs down.
We are using to bring compact cars to the market, like the new Citroën C3, that we bring to the market at 23,000 euros, which is the core of the market in terms of pure EV, and that price is extremely competitive. It's on par with the Chinese capability, and that kind of offering is also profitable for Stellantis.
And the Renault CEO Luca de Meo also spoke to us in Paris about plans to compete with Chinese rivals on the EVs and hybrids.
We have a strategy since 4 years on two legs. One is we have very strong hybrid technology, it's working pretty well. We're number 2 and number 3 in Europe on the hybrid segment, on all segments. But on the other side, we made the decision to develop two platforms, one for small cars and one for medium cars, full electric, because we think that these are two different sports, and an EV and an hybrid car are two different animals. And here you see the result. The good thing about that is that you can get out cars like Renault 5, Renault 4, or the Twingo, a legendary product, with the best, probably the best EV platform for small cars in the world.
Right, and then in terms of this sort of magic number for the pricing on EVs, what do you think that is in order to have it really take off here in Europe?
Look, I think we speak too much about list price of the car. What you should include in the equation is also, the cost of using this thing. So normally charging is 50%, 30% of fueling, okay, and the maintenance cost that is actually half on a car. So normally we should talk about that. But if you look at the Renault 5, it's 25,000 euro as a starting price. It's actually 10,000 euro less than any of the competitors. Why? Because we actually focus on the whole ecosystem, the platform on this. With the Twingo that you see, close to us, we will be able in 2026 to go below 20,000 euro in entry price. I think it's a kind of a decent, proposition already.
Renault CEO Luca de Maio speaking to Bloomberg's Oliver Crook at the Paris Auto Show. And staying with automakers, we're now seeing Volkswagen, BMW and Mercedes scrambling to recover in their most lucrative market, China. The German car makers are playing catch-up in the EV transition. EV supply chain reporter Danny Lee joins us now with today's Big Take. Danny, so what kind of risks do these German car makers face in China, and how much of it is really an existential threat?
Yeah, absolutely. China representing as a most lucrative foreign market for these German automakers. As you say, Volkswagen, Mercedes, BMW. They've basically got around $38 billion worth of investment at stake in China right now. And when you look and see just how they performed in the third quarter, the most recent quarter that's just gone, we saw BMW report a drop in sales of around 30%, and that's its worst performance in 4 years. We also saw Porsche reporting a 19% fall, and that's its worst performance in China in 10 years. And then when you look at someone like VW, Volkswagen, it's a mass market brand. It saw a 15% drop, and for them it hurts a lot more because they produce a lot more cars, they sell a lot more cars, and so the pain is being really felt when they have high volumes, high fixed investments and high costs that they're not seeing the sales materially generate. And then for them in the China market now, German automakers, they are struggling because they now represent around 15% of Chinese sales overall in terms of auto sales. That's down from around a quarter from pre-pandemic levels. And overall, that might sound like small numbers, but that represents hundreds of thousands of cars that would have otherwise been sold to German automakers, but is now going to Chinese automakers and even Tesla. So for the German automakers, they have a long way to go to try and catch up, but it does remain to be seen whether they are doing things too little or too late.
I mean, what a reality check, right? Because this has been historically such a strong relationship. What went wrong, and can they sort of turn it around?
Yeah, when you just look and compare Chinese automakers in particular, because they've come up really fast versus the German brands, when you look at their digital experience, Germany's automakers have been criticised for falling behind on having products and cars which have such great digital features that Chinese customers frankly really want. Things that will allow their smartphone to connect better to their car, and features which are more seamless in helping in daily life. And so that has been a criticism. And when you just look at even the hardware, the performance of the cars, this is also where Germany's automakers are falling behind. And so not just on hardware, software, on price. And this is clearly quite a crisis when you look at how German automakers have to try and catch up and try to level the playing field with the wrong price, the wrong product, and not really necessarily being totally in touch with what Chinese consumers really want.
Do German car makers symbolise a bit of a crisis facing a lot of foreign brands, if not all foreign brands, or is there a difference in terms of what we're seeing?
Yeah, I think for Germany's automakers, it kind of sums up the struggle for all foreign brands, basically. But we haven't seen we've seen the German automakers not take this lightly. They are trying to lead the fight back, because we've seen other foreign automakers, where you look at this, some of the US or even French and Korean brands, really fall away quite quickly, exit the China market. The German automakers are trying to retain their share, particularly as they partner up more deeply with some of the Chinese brands. We saw Volkswagen partner up with Xiaopeng. We've seen BMW partner up with another Chinese automaker. So there is efforts underway to try and deepen the relationship with the Chinese automakers here. But I think it does have to remain to be seen whether, again, too little, too late, and whether they can really turn it around from here on in, because the Chinese automakers are growing in strength here, and the German automakers really have a fight on the hands even in their own home market.
Danny Lee, EV supply chain reporter there. We have more ahead on the Asia trade. This is Bloomberg.
Australia is seeking to introduce reforms to merger rules as it faces an economy that's become increasingly concentrated, with only a few companies dominating some key sectors. That's the focus of today's Australia Ahead. Let's bring our business reporter Angus Whitley, who joins us to put things into perspective for us. So, how are we seeing the situation where big businesses and key sectors in Australia are facing less competition, and how has, I guess, the regulatory environment perhaps allowed for that?
Yeah, Heidi, it's a topic that certainly is come to the fore in the last, well, certainly in the last 2 weeks, but it's an omnipresent concern in Australia. And I think it's really put in sharp relief by last month's action by the competition regulator, which sued Coles and Woolworths, which control the supermarket sector in Australia, for allegedly making false discounts on hundreds of goods. So according to the competition regulator, they were keeping standard goods at certain prices for a long period of time, 6 months, even over a year in some cases, elevating them for a few weeks and then reducing them and claiming they were discounted goods when in fact they were higher than the prices they were at for a long period of time before. And since then, we've seen the government really move to act on this competition concern. It's, as you said, it's put more money into the competition commission to put more scrutiny on mergers and acquisitions. It's given it more money to really scrutinise the supermarket and retail sector. And I think this is particularly key now because we're in the end of an election cycle. We're due to have a federal election early next year by May 2025. And the cost of living is really up there, first or second concern amongst voters. So when you see topics like consumers allegedly getting gouged and misled when it comes to their grocery bills every week, which is one of the main drivers of inflation, government really has to act. And I think that's why it's a particular concern now, and we're seeing a lot of movement from the government. But outside of supermarkets, it's, you can see a lack of competition in arguably maybe a dozen sectors in Australia that probably need action and aren't getting it.
So what about the sectors with the most concentrated competition then?
Well, look at the supermarkets, for instance. You've got Woolworths and Coles. They together have just over half the sector, and it's really pretty hard to go past those two. Aldi, yes, has grown in recent years, but it's a different kind of product lineup. Few people can really do all their grocery shopping at Aldi, so it comes down to Coles and Woolworths, or Woolies as they're known colloquially. But beyond that, you look at aviation, we've got two dominant airlines. Qantas controls more than 60% of the market when you include its Jetstar low-cost offering. Retail, you've got Bunnings, controlled by Wesfarmers, and Woolworths also has retail arms. So in many cases, it's even difficult for consumers to know where they're shopping and who the ultimate owner is when it comes to sort of low-cost retail. And then look at financial services. You've got four banks: NAB, ANZ, Westpac, and CBA control the vast majority of the mortgage market. It's very difficult to go past those four as well. And that's even before you get into the sort of the global lack of competition in internet search and app stores and things like that. So it's an area where consumers face little choice, and that means less pressure on the cost of day-to-day goods, less competition, and that has a whole trickle-down effect on a raft of key economic metrics which don't do the economy any favours.
Bloomberg's Angus Whitley there. Let's bring in for some analysis our next guest, who joins us to talk about the broader competition landscape. Tom Kierath is a head of consumer research at Barrenjoey. Tom, really great to have you with us. So just picking up off, the sort of context that Angus gave us before, how do you see this as potentially trickling through to the broader economy, to the nature of competition, the impact on consumers, on investors?
Yeah, I mean, it's a really topical debate we have with investors at the moment around competition. And unfortunately, there's no way to fix it. There's no way to bring in a whole lot more competition. If you look at some of the statistics, you can see that Aldi has one share, Amazon has one share, and Bunnings has one share within the supermarket category as they've introduced new products. So we actually argue that the major two supermarkets have gradually been losing share over the past kind of 10 years. Would you like to see more competition in the industry? Absolutely, but it's just very hard to do that in a practical sense. So I think we will get some regulation come through and some clarity around what practices are fair, because obviously lifting prices for a couple of weeks and then doing a 50% discount, it doesn't seem fair to consumers. So I think the supermarkets will appreciate that, to be honest, having a bit more clarity around how to promote and how to communicate their promotions and their value to shoppers. But yeah, look, it has really weighed on the shares over the past kind of 6 or 12 months now. And it's something that, it would be great to kind of put behind us, I suppose.
What are the sort of meaningful implications of these latest merger rules, the mandatory notification change? Do you think the implications are going to be dramatic?
I'm not sure they'll be dramatic. I just think it'll be harder to do M&A going forward, because the ACCC is taking a lot tougher stance on competition and M&A, which I think is probably almost reflecting on what's happened over the past, that they've probably been a bit too lenient. So I would say most of the major businesses in Australia, the retailers, for instance, that they'll struggle to do significant M&A, and even like single store acquisitions will be tricky as well. So hopefully that helps the independent sector and gives them some vibrancy and enables them to be a bit more competitive, which we're definitely seeing with the Metcash business, which supplies independent stores, that they've become a lot more competitive and a viable alternative in a lot of industries to the major supermarkets or the hardware chains that are in the country at the moment.
So, Tom, what does this really tell us about how Australian regulators are looking at the landscape right now, especially with the actions from the Australian Competition and Consumer Commission?
Yeah, I mean, I think that they're taking a lot tougher stance on all M&A, and you can see that with the merger between Sigma and Chemist Warehouse that's currently on foot at the moment. The ACCC's had a really careful look at that, even though one business is a wholesaler in Sigma and Chemist Warehouse is a retailer. So I think you'll see a whole lot more scrutiny around M&A. And the diligence that the management teams will have to do to get these deals done will be more difficult. But the reality is, I think, as was pointed out earlier, there are a lot of industries that have a whole lot of market consolidation, and so you're probably not going to see wholesale M&A happen. In certainly a bunch of the retail industries that are obviously really pressing for the consumer. The consumer is very focused on value at the moment. And I think the ACCC is trying to help them out by increase the level of competition in the market at the moment.
So these lawsuits against Coles,
I wanted to ask about airlines specifically.
What does that mean for these companies? Sorry, I'll take it from here, Heidi, because I was still on the lawsuits from ACCC, where those are against Coles and Woolworths. What does that necessarily mean for these companies then, especially when it comes to the consumer trust and competition and also just their reputation?
Yeah, well, there has been a loss of consumer trust. We can see that. Both Coles and Woolworths publish their voice of the customer scores, which are surveys done by consumers as they leave the store, and both those metrics are lower than where they were in 2019 levels. That they kind of spiked during COVID, when supermarkets were everyone's friend, they're the only place to go and spend your money, and they've really fallen dramatically. So I think one of the things they'll have to do is rebuild that trust, and there's a few ways that you can do that. One is by improving your offer and the value that you offer consumers. which they're actively doing at the moment, but there's probably some more work to do there. But I think the other one is that the rate of inflation is coming off, and so consumers, going forward, probably won't see the same magnitude of price increases coming through, which should help repair the reputations to some extent of Coles and Woolworths. But yeah, look, it's definitely something that is front of mind for both the management teams, and we've got a couple of strategy days coming out and a new CEO at Woolworths. So it'll be interesting to see how they grapple with those issues.
Kierath, good to have you with us, Head of Consumer Research at Barrenjoey. And we have breaking news at the moment. We're hearing that Biden officials have discussed capping sales of advanced AI chips from Nvidia and other American companies on a country-specific basis. That's according to people familiar with the matter and speaking to Bloomberg. Now, this will be a move that would limit some nations' artificial intelligence capabilities. Let's bring in our tech reporter, Annabelle Drewlers, joining us now with the latest on this breaking story on the Bloomberg terminal right now. Belle, what are the implications of this?
Yeah, so I think we need to set sort of the context here. So what this is sort of referring to is this program or policy that the US already has in place around restricting certain technologies or exports of certain technologies to places like India and China. Last month, that framework, which is called the VEU program, was expanded to include data centers. And now we're hearing from sources that it could be expanded even further once again to expand on not only export of certain chips that are going to be used for AI servers, but to the Middle East in particular. And I guess the concern around this is that, of course, there are a lot of places or companies in the Middle East that have very deep pockets, and there is that continuing relationship that we're seeing growing between the Middle East and China in particular.
Tech reporter Annabelle Drewlers is there. We do have more ahead on the Age of Trade. This is Bloomberg.
Bankers are working on more than $6 billion of initial public offerings in Japan and India this week. It's a much-needed boost from two markets that have become an increasingly important revenue source as deals in China slump. Asia Equity Capital Markets reporter Julia Fioretti joins us now. Julia, what sort of deals, what sort of IPOs are we looking at?
So we're looking at a lot of deals this week, and it's actually getting quite busy in China as well. But outside of China, we have Tokyo Metro, which has priced its shares at the top of the range and raising $2.3 billion. That's Japan's biggest IPO in 6 years. In India, we have Hyundai's India unit, which is seeking to raise as much as $3.3 billion, and that's a record IPO for India. It's going to beat Life Insurance Corp's IPO a few years ago. And we also have another IPO in Japan from Rigaku, and together those three IPOs will push the volumes, at least just this week, to $6 billion. So that's showing that there's a lot of activity outside of China. India's been busy for quite a few years, but now we're finally seeing those larger listings come through that investors have been waiting for, and everyone will be obviously waiting to see that they perform well, to see if this rush can keep going.
That's a question, isn't it? What do we see as being the catalyst that can sustain this momentum?
Well, bankers are pretty bullish on India, and they don't see much that can actually break the momentum. Firstly, there's a steady stream of savers inflows into the market, and that is sustaining the equities, sustaining the equity valuations. And so, if there isn't really a big upset, some big mishap with an IPO, it's hard to see how this will stop. Obviously, valuations are quite high, but still, investors are still piling into these offerings. Similarly, with Japan, it's quite a hot market. If the Tokyo Metro goes well, it's one of the largest privatizations in recent years in Japan. As long as that goes well, then that could also pave the way for more IPOs.
Julia Ferretti, Asia Equity Capital Markets reporter there. As we look ahead towards trade in China, of course, we've had several pieces of news in the last couple of hours. Caixin saying that China could be raising more than $800 billion of government bonds over the next 3 years. This is Bloomberg.